Welcome to the Disruptor Network podcast.
Welcome back to the Disruptors Network podcast. We have another installment of the Growth Project. The Growth Project is designed to help you with whatever your real estate needs are, whether you're looking to buy your first property, invest in another one, buy a second home, become an Airbnb mogul, or just start with an interest around real estate. We're trying to give you the tools to help you within real estate. This week, I wanted to speak about something that's kind of top of mind for everybody right now, and that's rising interest rates.
Ignition, liftoff.
What we've seen over the last few years is historic low interest rates. What we're being told for the last 6 to 8 months to a year is that higher interest rates were coming, that inflation was coming. In fact, what has happened is the Federal Reserve, who controls the borrowing rate for banks of interest rates, has said this year they're going to raise that rate at least 4 times at 4 separate meetings. They have so far stuck to that plan, and they're saying that they're going to continue to stick to that plan. When that happens, obviously the rate that banks are giving you to borrow when buying a home on goes up. So rates have gone from the high 2s and the low 3s into the high 4s, low 5s, possibly mid 5s, depending on your situation, which is giving people less buying power when they're going out there to buy a home, especially in a market where we're devoid of inventory of homes for sale. So there's bidding wars still consistently. So even these rising interest rates have not stopped those bidding wars. The reason being is that there's such a shortage of homes for sale and such a high demand that it would take a lot more than high interest rates for a couple of months to really wane that demand to get back to a normal market. Inflation makes this a little bit more scary because not only are interest rates up, but cost of goods are way up. Rent, which is super important for this conversation, is way up. So everything kind of across the board, gas, food, everything you're doing for your household is up at this point now. And that being the case, now higher interest rates is compounding that problem. A lot of what people aren't seeing behind the scenes is during COVID, during the pandemic, the government dumped billions of dollars into the economy through PPP and supplemental programs to put money into the economy. Between unemployment and PPP loans and loosened guidelines on lending, they put a lot of money into the economy, which not only accelerated inflation, it made us look at a market that wasn't necessarily real. With that money, people had some extra money. Whether we want to admit it or not, people had all that extra money. So what they were doing with that money was vacationing more, spending more money on their credit cards, shopping more, which has further increased consumer spending, which has put inflation on even more of a fast track. So what does this mean for interest rates now? What does this mean for your buying power now? Where are you now and what should you be doing? So the first question I kind of want to pose is what my personal view is on the interest rates in this market. We're in a very volatile situation because it's just unstable. Whether rates are coming up or going down, what we really look for as a mortgage banker or as a real estate professional or somebody buying in the market is you just want stability so you can hit the target. Right now, you're in a market where rates are really fluctuating on a weekly, monthly, and even daily basis a lot of times, a great deal. And it's creating a moving target. So it's hard for you as a home buyer to create a budget and stick to that budget when the interest rates are becoming moving targets. So what we really want in this interest rate environment, what I'm hoping for, and what I do think you're going to see is some more stability over the next 2 to 3 months, where you're going to see the market, whatever it's going to be, whether it's going to be 5% or 6%, it's going to stabilize somewhere. And we're going to know at least, we're going to get back to that number, how much is going to cost us per every $100,000 we're going to spend on a home, whether it's $500 or $600 per every $100,000, we're going to get to know what that number is that it's going to cost us to buy a house, right? So what we really are hoping for and what I'm shooting for, what I think we're going to see over the next couple of months is stability. And that's what we really want. And I know rising interest rates and higher interest rates are never a good thing, but if we can get a stable rate market, then you could, as a buyer, could make a budget and stick to that budget and know what your buying power is. Right now, it's really hard to determine what your buying power is. And along with that, if you have been pre-approved or you're looking in the market right now, it's important that you are consistently checking if the numbers still work. Rates are moving so much that day to day and week to week, it could be a lot different in your payment than you think it is. So if you were pre-approved a week ago, a month ago, a year ago, 6 months ago, it's time to freshen that up and find out what current interest rates are and what your current payment will be, because that's the most important thing. More important than your rate is what your payment is every single month that you have to pay on that house. So I'm looking for and I'm hoping for stability over the next couple of months, whatever that's going to be. And I think that's what you'll see. The next question is how should you strategize around these interest rates, right? So how do you make a strategy around interest rates that are consistently moving? In a market where a target rate, like a specific rate, is hard to lock down, it's important that you know your budget, and we've talked about budgets before, and decide around best and worst case scenario. So it's important that you know what your budget is. So I know what my cell phones cost every single month. I know what cable and Wi-Fi. I know what my Netflix costs. I know what my food costs, my gym membership, my medical expenses. Those are fixed costs. I can handle those costs. They're not changing so much. Food may vary, but your gym, your cell phone, your insurance, pretty much you're locked in on those costs, right? So I know what my fixed costs are. So have a budget with your fixed costs. After my budget, what kind of payment can I afford for housing? So if that's 2,000 to 3,000, whatever it is, what kind of payment can I afford to housing? When you go out to shop in the market, this is what I can afford based on what payment can I afford. So what you want to do is strategize around your budget, right? Whatever your budget is, that's what you're strategizing around, not interest rates. This is my budget. This is how much I can afford. With that being how much you can afford, this is the loan amount I can take at today's current interest rate. So that's what you want to do first. And when I was doing that, I would work on a range, right? So when you speak to your mortgage banker or the person that's pre-approving you, ask them to give you a payment within a half a percentage point of each other. So, because that's where how much it can move. So if today's rate is 5%, then hey, give me payments between 5 and 5.5%. So I can figure out what my high is and what my low is, right? Or give me a payment at 4.5%, 5%, and 5.5%. So I can know that, okay, this is really the max I can spend. This is what I really want to spend. And this is best case scenario, right? So give yourself a range to go out and shop with, and don't just focus on one rate. Oh, the rate's 5% today, I'm shopping at that rate. Don't do that. Give yourself a range. That's the best way to strategize for this in the future. Thirdly is, if you're not me or you're not somebody who's professional in this business, if you're not a mortgage professional, how do you keep updated on this market to know where the rates actually are? So with that, Fannie Mae and Freddie Mac put out rates, pretty much an average rate, interest rate for the week and the month, every single week and every single month. Those rates are published. They're going to be published on Bloomberg and CNBC, Yahoo Finance, the Wall Street Journal. They're all going to have Fannie Mae or Freddie Mac's average interest rate for the week. That's your gauge, right? That's the interest rate, that was for that week on average, and you can bet around that interest rate that's going to be somewhere around that number. So to keep yourself informed, just put the news alerts on for those websites specifically, and you could just go into apps like Flipboard or Apple News or something like that and put an alert on for mortgage interest rates. And every single week when that comes out, you'll get an alert. So that's how you kind of keep yourself informed. So when you go speak to a mortgage banker or a real estate professional, you can have an informed conversation. How patient should you be with interest rates? This is a question that comes all the time. And you speak to a lot of people who become market predictors that are, well, I think rates are going to come down. Well, what is your theory? Why do you think that's going to happen? Why do you think interest rates are going to come down? And a lot of times it's just like, have a feeling. That's not how this works, right? So I don't think you should be patient with interest rates. I think that if you have an interest rate currently that meets the payment that matches your budget, then you lock that interest rate and you don't gamble, right? So if you can get an interest rate today that matches your budget, then you lock in on that rate. Do not gamble that they're going to go lower, because historically they will go higher faster than they will go lower. When they go high, it happens very, really, really quick. When they go up, it happens quick, right? It's just like a panic sell, just like the stock market. There's a sell-off quick and rates go up. When they go down, it's usually a gradual process. So that eighth of a point or 0.25 or 0.125 that you're looking for an interest rate to go down could cost you 0.5, 0.75 at one point going up if you're not careful. So do not gamble with interest rates. If you have a payment that you're comfortable with today that fits your budget, then take that payment. I do think that you're going to see rates possibly go up a little more. I think we're getting to a point where we're finally plateauing. It's gotten to a point, and mortgage banks and interest rates, it just, a lot of times what we're going to follow as a gauge is the 10-year treasury note. So you can look that up. It's on every financial news website, 10-year treasury notes. That 10-year treasury today, as we're recording, is somewhere in the 2.7s, 2.77, 2.73, somewhere around there. It seems to be having a hard time breaking that barrier, right? So I think we're getting to a point where we got to some sort of stability, and it could come down from here, but I don't think it'll go up that much. So I think we're starting to see whatever the top's going to be of this. I don't think we're going to see a significant raise from here on out, but I could be wrong. Here's another really, really good question. If you're in the middle of negotiating a house and rates rise, what do? Listen, your buying power changes when interest rates go up. So in doing that, again, give yourself a range. This is absolutely the most I can pay. This is what I'm paying today, and this is the least I'm hoping to pay. But you should have a top number of what you can pay and never go over that number. You don't want to stretch yourself out, especially in an environment where we have inflation and costs going up. Don't overstretch yourself at your mortgage payment, especially in this kind of volatile environment. And lastly, what I want to pose to this is, what are some key mistakes to avoid in the process of locking interest rates? So to avoid financial losses, it's important to first know your budget, like we spoke about, including your mortgage payment, then locking your interest rate in when your budget is met at that given day's rates, right? So whenever you get to the point where like, okay, this payment meets my budget, this is what interest rates are today, let's lock in. Do not gamble with that. Don't overshop and or over gamble for rates, because if you get a rate that meets your needs from a bank, I'm not telling you not to shop and not to have a competitive rate, but truth be told, and somebody may tell you this, somebody not, most banks are selling the same exact product and very, very close to the same rates. Even if they're different, they're going to be within a quarter point of each other, 0.25% of each other. So don't shop too much, because when the rates go up, they go for everybody. They don't go for one bank. When rates go up, they go for every single bank. So you may be shopping around and rates may go up the next day, and the rate you have with the other bank may not be there when you come back. So don't shop or gamble too much. What you're going to lose in that, I promise you, in gambling or shopping too much, is more than you'll gain if they go down. So in this interest rate environment, it's still a good time to buy homes. It's still a good time to lock in that mortgage payment. 5% is still a very, very low interest rate. Rents are rising faster than mortgage prices, and mortgage payments are rising because of interest rates. So rent is rising faster than housing prices are rising. So you still want to buy if you can. If you want to check out more from the Growth Project and Disruptors Network, check us out on all the podcast networks, Apple, Spotify, Anchor, and our YouTube channel, which is the Disruptors Network. I'm Ralph D. McNary. You can get me on Instagram and Debug. Hope to see you guys again. This is another episode of The Growth Project.